Hello and welcome to today's Market Matters video update. I'm Harry Watt, joined by James Gerish. Today it is Thursday the 4th of May. We're going to start with performance for last month and then talk about what's going on in the market today. We've had a bit of a pullback in terms of the banks, but kicking things off for April, James, how did the Market Matters portfolios perform, given there was actually a little bit of a rebound in markets through the month?
There was. So to give you a sense of the backdrop for markets in April, it was up. The ASX 200 accumulation index was up 1.85%. So a positive month, and it's been a reasonable recovery after a pretty choppy first part of the year. The flagship growth portfolio did well in April, so it was up 3.33%. So about a 1.5% outperformance of the benchmark. So we're happy with that. FY23 to date, it's up nearly 24%, Harry. So it's about 8% above its benchmark. So tick for that portfolio and how that's progressing. The income portfolio did 1.88% in April. So it holds equities as well as fixed income securities, as listeners or viewers will no doubt appreciate. So that added, as I said, 1.88%. It was about 1.2% above its cash plus 4% benchmark. It's up 11.3% FY23 to date, so about nearly 6% above its benchmark. The emerging companies portfolio put on 2.33% in April, slightly under its benchmark, but only by about 40 basis points. And FY23 to date, it's up 11.76%, so in line with its benchmark. And the international equities portfolio had a stormer. It was up 4.33% for the month. We had a couple of companies that reported really well, so that drove performance about 1.2% above the benchmark, and it's up about a bit over 22% FY23 to date. So all in all, Harry, I was really comfortable. I've said it a number of, in recent months, the portfolio performance is going really well. We're happy with our positioning. We're happy with how that's translating into the returns of the portfolios are achieving as we move into what's going to be probably a pretty tricky full year results period for Aussie stocks.
Just on that portfolio positioning, James, now that we've seen a little bit of a bounce out of those March lows, we're coming into May. The typical call is sell in May and go away. How are we positioned at the moment across the portfolios?
We've done a little bit of selling prior to, in the last month or so. So as the monthly reports will go out for our Market Matters Invest portfolios, will give you a better understanding of how we're positioned. So flagship growth portfolio has increased cash to about 11%. We've got about an 8% position in gold. So you combine those things and you say we're about 20% position fairly defensively. We've got a reasonable healthcare exposure as well. It's about 13%. So as markets have been strong, we've transitioned into a more defensive stance, and that's true right across the suite of portfolios. So our view is that we're not overly concerned about the market at the moment, given what's playing out in terms of investor positioning. Cash levels are still high. Allocations to bonds versus equities are still very high. So I'm not concerned here about the market from a significant impending decline in the market. I don't think we're about to go into something like that. But it's volatile, and there's indecision around what central banks are doing, headlined by the indecision clearly by the RBA this week. So I think some flexibility going to reporting is always key. We often speak about having flexibility and cash levels going into reporting periods. That's what we've got. So when I say we're comfortable with our portfolio, we are, our portfolios, we are more defensively positioned, Harry, going into this period.
One of our key sort of weights to portfolios at the moment, in particularly the flagship growth portfolio, is we're a little bit underweight the banks at the moment. NAB's come out today and the stock's down about 6-7% this morning. Just give us a run through their first half result that they announced this morning.
Yeah, so we own NAB and we own ANZ, but we've got about a 10% portfolio weighting in those two names. NAB came out this morning. Result was slightly underwhelming, but the stock's down 7.5-8%. That's a pretty aggressive decline in terms of share price for the result that they delivered. From an earnings point of view, though, it was about cash earnings 4.07 billion for the half. It was about a 2.5% miss to where we thought it was going to be. The concern in the market is around the net interest margin at 1.77 versus 1.83 expected, but the second quarter NIM was 1.76. So basically saying that margins in bankland have peaked. And that's a result of higher competition for mortgages, higher competition for deposits, and that's eroding some of the margin benefit that gets achieved from higher interest rates. So, the NAB's NIM was up 14 basis points, but it was still slightly below where the market expected it to be. Their dividend of 83 cents was pretty much in line with the 84 expected. So look, their arrears and all the asset quality and capital on their balance sheet all looks tickety-boo. It's just a slight readjustment by the market around the NIM expectation and what that means for their full year, the second half earnings. So the market, I think, is looking for cash earnings of about 8.1 billion for the full year, 4.07 for the first half. Given the trajectory of margins that we saw coming out of the second quarter, plus a few other bits and bobs in NAB, it's probably going to make it a little bit challenging for them to meet full year guidance. So I'd expect downgrades to earnings expectations out of this result from NAB, but I don't think it warrants a 7.5%, 8% fall in the share price. So that's sort of, it should be down a few percent, but not the extent that it's trading at. It'll be interesting to see the other banks as they report numbers shortly, Harry.
Yeah, so we've got ANZ tomorrow. Like you said, we own ANZ. It'll be really interesting to see how they update us on the takeover of Suncorp's Bank. We've got Macquarie tomorrow. We've got Westpac, their half year next week, and a quarterly update from CBA. The market sort of extrapolated NAB's result a little bit and taken a bit of the shine off the other banks as well. Are we seeing this as maybe a NAB specific issue, or are we looking forward and saying these other banks might do a little bit better?
Good question. So one of the reasons why NAB's margins were lower than expected was their citing competition in the space. So CBA at their last result called this out and said that there was they were seeing in the market non-commercial loans being written. So there's this big cohort of Australians that are rolling off fixed rate mortgages towards the back end of this year and early next. The banks are doing a land grab to try and entice new customers on board. To do that, they're writing, they're pretty aggressive in their pricing, and that has an implication for net interest margin. So I would suspect, my concern would be that ANZ is going to have margin issues tomorrow because you look at their loan growth numbers and they've been pretty aggressive growing their book. So that says to me that they've been aggressive on pricing. So that means that, in my perspective, they'll have a margin issue. But NAB and ANZ, in my view, are priced very low for the quality that they're delivering. I mean, ANZ's one of the cheapest banks in the sector, and that's why we own it. We transitioned out of CBA at $110 a share and bought ANZ. It's still been the relative outperformer since that trade was put on. So, look, I sit here and say we've written it in reports in recent weeks. We were comfortable with our banking exposure, but we would increase it if they drop 10%. NAB's dropped 7.5% today, 8% today. So on my side, I'm more of a buyer of this weakness than anything. If they continue to slide, we'll increase our weighting to the banks. There's no doubt about that for our growth and income portfolios. So I'm more of a buyer into weakness as opposed to anything else in the banking sector, and look forward to ANZ's result tomorrow. It'll be interesting to see whether or not the question you raised is right across the sector.
I'm going to throw a little curve for you too quickly, James, as well. We don't own any regional banks. We've had a couple of updates out from the regional names lately that their deterioration is a little bit worse than what we've seen in the Big Four in particular. Is that an area you'd look at for a little bit more leverage in the financials and the bank space into this weakness?
I'm going to say no, only because when things toughen, scale becomes more important. So size matters. So we've seen it over in the US, and obviously they're a massively different banking space over there. There's 4,500 banks over in the US. We've got a fraction of that here in Australia. Confidence is really key in banking. I think Australians are very confident in the banking system we've got, but it comes down to scale and being able to deliver. If the funding environment toughens and gets, the availability of credit toughens, it's having that size and scale and the ability to write commercial loans that are really important for profitability. And I don't think the regionals have that. We've written recently, and I won't digress too much, but we've written recently about Bank of Queensland, and obviously they've got a new CEO. Well, it was the old chairman become CEO. They've got a global search, but I suspect they're cleaning the decks to try and entice a really high quality CEO to turn that business around. So never say never. Bank of Queensland's on our radar, and it's one that I think in the coming 6 months, 12 months, whatever it is, there will be a trade in Bank of Queensland, and we'll make money out of Bank of Queensland. I don't think we're there yet, but it's on our radar, Harry.
All right, that's all we've got for today. I hope you enjoyed our video and hope you got something away. Pretty comfortable with the banks here and pretty comfortable with performance at the moment.